welcome back to the accounting section. This video will be about the accounting cycle and we'll go through its steps. So let's start off by defining the accounting cycle. The accounting cycle is a process designed to make financial accounting of activities easier for business owners and also accountants themselves. This cycle usually comprises a year or another accounting period. So this means that typically the start of the accounting cycle would take place in the beginning of a company's fiscal year, and the end of the cycle would take place at the end of the fiscal year. A fiscal year, for reference, is basically a 12-month period that companies use to report its finances. So, back to accounting cycles. Nowadays, there's a lot of accounting software online that automates the accounting cycle. Some popular softwares that you may have heard of are QuickBooks, Pilot, and TurboCash. Finally, the accounting cycle is generally an 8-step process, from identifying and analyzing transactions all the way to making closing entries. I do want to say that I've also seen versions of the accounting cycle that are 7 steps and 10 steps. So now let's begin our quick walkthrough of the accounting cycle, starting with step 1, identify transactions. Companies will have many transactions throughout the accounting cycle, such as a sale, refund, payment to a vendor, and so on. Each one needs to be properly recorded in the company's books, so it's important to have copies of invoices, receipts, files, and so on. Step 2 is to record transactions on a journal. This is where our T accounts that we talked about earlier come in handy, because when you record transactions to a journal, you always use double entry bookkeeping, meaning there's always going to be a debit and a credit. So now it's a little hard to read, but on our right, here's the general journal of the Orion Computer Repair Company. The T account is rearranged, and for each transaction, there's a row with the date, the debit account description, the credit account description, the debit amount, and the credit amount. These journals are usually pages and pages long. Step 3 is to post your transactions to the general ledger. A general ledger is a database that stores a complete record of all accounts and journal entries. So it's essentially combining the journals that a company has. Now, before computers, the general ledger used to be this huge book that would be filled out by hand. But thankfully, we've moved on to using accounting softwares that would treat this like a database and automatically copy information from a journal. So here's an example of a general ledger on the right over here. Step 4 is to prepare the unadjusted trial balance. A trial balance is an accounting report showing the closing balances of all general ledger accounts. Here's how it would look like. As you can see, you've got the total amount this company has in cash, you've got the total amount in inventory, you've got the total amount in revenue, and so on. For this, the main thing to make sure is that all the debits match all the credits at the end. And for this trial balance, it checks out because we've got 187K on the debit section and 187K on the credit section. Step 5 is to post adjusting entries. This is where you go through your records and identify any errors and make those changes. Again, your main goal here is to make sure your debits and credits are equal, because when that happens, you know that you're probably not missing any transactions. Step 6 is to prepare your adjusted trial balance. This will take into account your changes from step 5. As you can see on the right, it basically looks the same as the unadjusted trial balance and is prepared the same way, with the debit amount matching the credit amount. Step 7 is to prepare financial statements. This will include the income statement, balance sheet, and cash flow statement. Don't worry about what exactly they are, as we've got a whole section just for these 3 statements. Just know that the data created from accounting is what's used to prepare these financial statements. Now, the final step is done at the end of the fiscal year, and it is to post closing entries. This step has to do with higher level accounting, so you don't need to worry about it for now. If you still do want to hear about it though, a company has to finalize temporary accounts, revenues, and expenses at the end of the period using closing entries. These closing entries include transferring net income into another account called retained earnings. Finally, a company prepares the post-closing trial balance, as shown on the right, to ensure debits and credits match and the cycle can begin anew. To the right is what a post-closing trial balance looks like. Finally, we're at the end of our accounting cycle, and if you didn't understand something along the way, you can always go back to that part of the video. If it's still confusing, don't worry. This is just an introductory finance course, and most of the steps in the accounting cycle require a higher knowledge of accounting. That brings us to the end of our video, and see you in the next one. Thank you.